Hello and welcome to our discussion on the issues relating to accounting. In this session we will try to understand the determination of profit or loss on the sale of property, plant and equipment and the way they are shown on the financial statements. The property, plant and equipment, when they are sold, the profit or loss is determined by deducting the written down value of the asset as on the date of the sale from the sale price of the assets. The written down value of the asset is equal to the total cost of acquisition of the asset minus the accumulated depreciation as on the date of the sale. Let us take an example to understand that. So the opening balance sheet shows some sources and some assets. The focus of our presentation is on this plant. So the plant is 200,000 and already accumulated depreciation of 120,000 is there. So the WDV, the written down value of the asset, is 80,000. Now the transactions are entire stock is sold. So when entire stock is sold for 200,000 for cash, and the corresponding cost of goods sold is 145,000. So the stock will become because the entire stock has been sold. Depreciation using SLM, we are going to show the depreciation. However, the plant is sold on 1st October, so depreciation will be charged for a period of 9 months here. So depreciation will be 15,000 because the depreciation is for the period of 9 months, and it is given that depreciation for the year is 20,000. So depreciation for the period of 9 months is 9 by 12 of 20,000. And on 1st January the plant is sold. On 1st January the plant is sold for 85,000. So the sale of plant is a inflow of cash, and we can show that the entire cost in the income statement, entire sale proceeds as an income statement with a corresponding cost or the WDV of that asset. But how did we get this WDV? Let us see the working note to that effect now. So the plant is the original cost of the plant is 200,000. The original cost of the plant is 200,000. The opening accumulated depreciation, is 120,000. The depreciation for the year is 15,000. Depreciation for the year is 15,000. And so for the year up to the date of the sale is 15,000. So depreciation as on the WDV as on the date of sale is 200,000 minus 120 minus 15 will give the WDV as on the date of the asset. And the sale price is 85,000. The sale price is 85,000, whereas the WDV is 65,000. So there is a profit of 20,000. But here, instead of showing profit, we have shown the sale of the asset and the cost of the asset. So the accumulated depreciation now will become 135,000 because up to the date of the depreciation will be 135, which is 120 plus 15,000. And the WDV as on the date of the asset will be sold. So therefore, to that extent, the value of the asset has become 0. You can see that it's become 0. So the sale of the asset is shown on the income statement and with the corresponding cost of the asset. There are different ways of showing that too, which we'll see later. Then there is a interest on the loan. Interest on the loan 4,500, and we assume that the interest is paid during the period. We assume that the tax will also be paid. The tax will be PBT is 55,000 and the tax is 30% of PBT, assuming that accounting profit is equal to tax profit, and the tax is a payment. So therefore we'll have the PAT is 38,850 and entire PAT will be transferred to the balance sheet. The cash in hand is equal to cash available. Cash available is 220 and cash payment is 21,000. So cash available is 198,850, and that 198,850 will be transferred to the balance sheet, and which is as a asset on the date of the balance sheet preparation. The profit is transferred to the reserves and cash is transferred to the asset. Now no changes in the capital, no changes in the loan. So the total of the asset side is 283,850, and the total of the sources asset should also be equal to 283,850. So the cash in hand will be transferred. Cash in hand comes from here. The accumulated depreciation comes from here. The weighted the WDV will be reduced to the extent the stock is not there, the loan has not changed, so cash in hand should be transferred to the balance sheet. Let us see cash in hand. Cash in hand is equal to 283,000. So the balance sheet tallies for us. So we can the focus of the discussion was on the profit on sale of the asset. So sale is shown and the corresponding cost is shown. This is one of the ways in which the asset sale can be shown. The other method of showing that is to show the net effect, that is the profit on sale of the asset directly, and the profit on sale of asset is shown in the income statement. Instead of showing the sale and the cost of the asset, we show the profit on sale directly, and this is a preferable method of presenting the profit or sale of asset instead of showing the sale and the cost of the plant. The distinction is because this is not a revenue good. The sale and the cost of goods sold are meant for the revenue good. So the profit on sale of property, plant and equipment is calculated by deducting the written down value from the sale, and it is shown either by showing sales and the cost separately or just showing the profit in the income statement. But this presentation, whether the profit is shown or the sale and the cost is shown, is not going to affect the income statement, will not affect the cash flow statement, because cash flow statement will show cash receipt from the sale of the asset. Thank you very much.